Hello, and welcome to our first episode of Root and Branch, a monthly review of the sustainable debt market. This is designed to be something relatively brief. Don't worry, we're not going to go on for hours and hours and hours. And I am happy to say I'm joined by Nina Flitman, one of our star reporters on LCD, who is specifically tasked with looking after the debt sustainability market. Hi, Nina, how are you?
I'm well, Chris. How are you?
I'm okay. The buds are blooming in my garden. My tulips haven't bloomed yet, but they are beginning to show, which is appropriate that we're starting this in spring. So this is meant to be relatively quick, so let's dive right in. So how about some of the deals that you've seen that are sustainably linked coming into the market right now? What are some of the features of the things that you've seen?
Well, we've seen quite a lot of leverage loans in the market where there is a margin ratchet linked to ESG KPIs. So earlier in March and February, we saw Start Group, we've seen Elson. Just this week, as we're recording, there was IFS, an enterprise software firm, coming in with a dual currency recap, which had an ESG margin ratchet. But what's interesting is how we've seen sort of new features coming in, people trying new things, people developing maybe new structures of how these margin ratchets can work, how ESG linked lending might look in the future.
Yeah, because the market's still finding its feet and still figuring out what to do. Because of course I'm a loan person, ultimately flexible are loans. So you get ups and downs in the loan market, as in you can, your margin ratchet may go up or down depending on how you perform. Whereas in the bond market, it's an entirely different story. So you've seen both things, I think, in the market.
So on the bond side, we've only seen a couple of names coming with sustainability-linked transactions. So one was PPC, which is the Greek power company,
Yep.
And they've actually gone with quite an onerous ratchet. So they're actually aiming for a 40% reduction in Scope 1 CO2 emissions from 2019 to 2024. Otherwise, there's a 50 basis point step up on the pricing of that transaction. And that's been followed by a shipping firm, Hapag-Lloyd, who's sort of gone along the same structure. Whereas on the loan side, we have got plus or minus margin ratchets mostly. So the margin can move either way depending on whether targets are hit or not hit. Something we've actually seen just very recently is a transaction from Belron, which is the vehicle glass repair firm.
Okay.
And they've done an imbalanced margin ratchet. So actually they can, let me get this the right way around. So they can save 7.5 basis points if they hit their target, but they will lose 10 basis points, as in they'll have to pay investors 10 basis points more if they hit.
So slightly more stick than carrot.
Yeah, so they're going to be doing something else as well. I understand they're going to be bringing a second target in, and actually the bringing in of that target is going to be going to move the margin as well. It's going to have a ratchet on it just to get the second KPI target on there. But I think it's interesting. So we're moving towards standardization. I think it's still a point in the market where we're exploring, where we're seeing what might work. But there's still a question, of course, of whether we want this market to be standardized, whether we expect all those KPIs to be completely the same across the market.
Yeah.
Suggesting that we're in a wild west at the moment suggests that at some point it's all going to come together and it's all going to look the same pretty much across every transaction. And actually, I don't think that's necessarily true. I think we are going to always see an element of a bespoke structuring in this, that we're always going to see slightly different things for slightly different issuers.
And one of the things that you and I have talked about in the past is actually this concept of how many KPIs do you have, and not just how many KPIs do you have, but how they're going to be set. So I chaired a panel last week for the European Leveraged Finance Association, and there was discussions about KPIs already in the money. If you're setting yourself a target that you're going to hit, that's not particularly impactful on your company. So you tell me, but I think we're pretty much seeing, actually at the moment, in many cases, just one KPI being set.
So some transactions have 3 KPIs on them, and some do just have one. And it seems to be sort of 6 of one, half a dozen of the other at the moment as what the preference is, because it generally is sort of the more KPIs you have, the wider ranging they are. Whereas if there's one, it seems to be very focused on that issuer and something that's very specific to that issuer. I think what investors want to see, though, is some materiality to the KPI. They want to really understand how this is going to change their business if they're going to be losing a very small amount of margin due to it. They do want something that's going to make a difference, and they don't just want something that the company is already moving towards or already at.
Yes.
As you say, if they're already in the money, or if they have to make a change, for example, one woman is appointed to management, and that's great, and then you can knock 5 basis points off your margin or whatever. They don't want to see that. They do want to see something that is going to change the business, that is going to move it forward with an ESG hat on.
And that's why I think it's interesting, actually, also looking at what bonds are doing versus what loans are doing, because from what you've said and from what I've read in the bond world, they are going for some actually really quite big targets that they're going to try and hit. And actually, the bond world is all stick. It all seems to be penalty, no carrot, but a pretty big stick. If you don't hit those quite substantial targets, it could be painful.
So that PPC one, it's a 50 bip step up. That's meaningful. But it's something that's something the company is already doing. So they've had this target in place for some time to move to reduce their CO2 emissions from 2019 to 2024. But there's a very decent step up in place, and so far it seems that the bond market is really enjoying that. So PPC, the original transaction, was upsized. Its tap earlier this week was also upsized, and they've taken the total size of that transaction to 775 million euros. And one banker said that if you do add anything green to a transaction and add any sort of element of sustainability, you can expect basically a 30 to 40% uptick in the size of a book. So certainly it's attractive to investors.
That's huge. That's that bond world, yeah?
Yeah, that's bond world, and that is one source. So
you
just got a very good day.
Yeah, no, that's huge. I mean, I do think it's interesting that it is all stick. So I guess therefore, as an investor in a bond which has that kind of a step up in, you're only going to win because you get your margin now, and it may go up if they sadly don't meet their ESG targets. Whereas at least in loan world, it's like if you do good, it may not be a huge benefit, but there will be some benefit. And interestingly, in some cases, they're handing that benefit to charity, or they're reinvesting it specifically in things to improve their ESG. They're not just taking the money into their pocket, which is something really, really new and fresh for the whole debt market.
Well, it's more difficult for loans, I think, to be quite as ambitious in the size of the step up, because obviously after a year of a loan, after a year of a loan, you can look to reprice, or sort of once it comes out to its 6-month call protection, you can look to reprice, and you can look to refinance. So if you've got a 10-year bullet investment grade transaction in the high yield side, you've got 10 years really to reach any sort of ambitious target that you're looking for. And even with high yield bonds, you've got a non-call 3 period, or a non-call 4, or a non-call 5. So you have longer to reach that ambitious target. Whereas with loans, after a year, you're probably not going to be anywhere near hitting a very ambitious target. So of course, you're not going to want a very onerous margin step up. So it's the difference, I think, between the two markets that has necessitated the difference between there.
Yeah, I guess in loan world, the loan lends itself to a more gradual thing. So you could have ups and downs over the course of a number of years, and you can gradually work towards a target. Whereas in bond world, like you say, because of the structure, it pretty much has to be one hit. Cool. Okay. Thank you very much, Nina, for this, our very first episode. If anybody has any questions for me or Nina, please feel free to send us them direct by email or give us a call, and we will be back again next month. Thank you.